Good afternoon, everyone, and good evening to our friends in Europe, and a very early good morning to some in the Asia-Pac region. Welcome to the Global Interdependence Center's executive briefing. I'm Bill Kennedy, your host, and this is the 9th program in our Analyzing Pandemic series. Today, we will explore the monetary policy response to the pandemic and its implications for growth, inflation, and the Fed's balance sheet. Today's webinar is sponsored by the GIC College of Central Bankers. It's an organization established in 2018 to sustain and enhance our relationship with former leaders of the world's central banks. The college offers a distinguished, neutral platform, such as this event, for research, discussion, and thought leadership on important topics related to central banking and monetary policy. As a reminder, today's event is being recorded, and the replay will be made available on the GIC website later today. So I'm thrilled to introduce our two distinguished guests, Dennis Lockhart and David Altig. Dennis Lockhart is the former president and CEO of the Federal Reserve Bank of Atlanta, where he served for a decade that spanned the financial crisis, the Great Recession, and the subsequent recovery. While at the Atlanta Fed, Dennis served on the Fed's chief monetary policy body, the Federal Open Market Committee, the FOMC. Since stepping down from the Fed in 2017, Dennis has served as a senior fellow at the Harvard Kennedy School and is currently a distinguished professor at the Sam Nunn School of International Affairs at Georgia Tech. He serves on numerous boards, both for-profit and nonprofit, and several advisory councils. And Mr. Lockhart was inducted into the College of Central Bankers in 2019. Before becoming a Fed policymaker, Dennis was a member of the faculty at Georgetown University and Johns Hopkins University, and he started his career with Citibank, which is now Citigroup, where he held various domestic and international roles working in Lebanon, Saudi Arabia, Greece, Iran, and Latin America. Dennis is a California native who was educated at Stanford and Johns Hopkins University at the Advanced International Studies program, and he served as an officer in the U.S. Marine Corps Reserve. Dr. David Altig is the Executive Vice President and Director of Research at the Federal Reserve Bank of Atlanta, where he advises the bank president on monetary policy and oversees the bank's regional executives and the research department. Dave also serves on the bank's management and discount committees. He leads the Atlanta Fed's famous macro blog, which provides commentary on monetary policy, macroeconomics, and the Southeast economy. Dr. Altig also serves as an adjunct professor of economics in the Graduate School of Business at the University of Chicago. Prior to joining the Atlanta Fed, Dave served as the Associate Director of Research at the Cleveland Fed and was also on the faculty at Indiana University. He has lectured extensively across the United States and around the world. Dave hails from the land of Lincoln, Illinois, educated at the University of Iowa, and earned his master's and doctoral degrees in economics from Brown University. We proudly count Dr. Altig as a member of the GIC Advisory Council. So Dennis and Dave, welcome to you both.
Thank you, Bill.
So let's kick off the discussion. Maybe a question to you, Dennis. So you had a seat at the FOMC table during the last economic crisis. What policy lessons from that experience do you think are applicable to this economy that's being negatively impacted by the lockdown? And if you don't mind commenting, and then I'll slip off and then I'll come back for the Q&A.
Okay, good. Well, the two crises are quite different in some respects. This one was caused by an exogenous factor, whereas it was really something intrinsic to the financial system in 2008. But the lesson I learned from that period is that when a crisis hits, particularly what you might call a black swan type crisis that comes out of the blue and it surprises everyone, it's very important to act quickly, act aggressively, basically use shock and awe to try to get in command of the situation and to change the psychology of the moment. rather than a more incremental approach with each development, taking a small step of some kind. In 2008, clearly Ben Bernanke and Hank Paulson and Tim Geithner, they were a sort of triumvirate that worked together. They really decided to pull out all stops, and this Fed has essentially done the same thing in a different set of circumstances. I think, clearly the Fed acted rapidly and acted with a full range, in fact, a wider range of programs and tools than used in 2008. Dave, you want to add something to that?
No, I think you absolutely nailed the key lesson from the crisis. Interestingly enough, I mean, there was a period that people sort of know about where prior to this pandemic crisis, the FOMC was doing kind of a monetary policy framework review, which of course involves thinking about those lessons from the crisis, and the need for aggressive action comes right to the fore. And we're very fortunate that the capital to invoke some of the emergency mechanisms to deal with financial market stress had not been lost. There was still lots of the principal players in the staff were still around, and people remembered. So it was possible to stand up things pretty quickly. Now we went beyond that toolkit quite significantly so far, and in part a real difference between then and now is that at the time, as kind of you recollect, there was some notion of mixing sort of these tools to deal with financial market dislocation and stress with very traditional aggregate demand tools, really traditional monetary policy. That route's really not that important right at the moment. When you shut down the economy, there's not much you can do to stimulate demand. So that sort of makes this episode a little bit different than the last one.
The last one was, even though our memories of it is it basically was an all-consuming exercise in 2008, it was actually a little bit more of a rolling crisis, whereas this one suddenly came on, and within literally a few weeks, enormous damage was done to the economy.
Yeah, you see the decline in industrial production and employment went well below the levels that we saw in the trough of the Great Recession in virtually the matter of weeks, as opposed to the year and a half and longer that we saw the financial crisis play out over.
Yeah. Dave, I thought we might start by trying to get a fix on where the U.S. economy is at the moment. In my view, I see sort of conflicting themes at work. The financial markets are really pretty optimistic at the moment. At least the equity markets seem that way. And yet the beige book that came out a few days ago is sort of sober in what you're hearing from Main Street America and with all the contacts that the regional banks have. This morning we had another initial claims report, over 2 million initial claims. So, round numbers, 40 million people out of work. That's about a quarter of the workforce. What are you looking at to get a fix on what the current situation is?
Well, there isn't a whole ton you can actually look at. The data is just off the charts bad, and a result of policy aimed at containing the virus. I mean, it's a very the kind of very large question is how much of this is actually sort of structural, a structural problem that's going to persist once we begin to open up. Now we're starting to get some signal of what that might look like. It seems pretty clear if we, by looking at all measures of the novel sorts of statistics we've begun to look at, tracking kind of telephones to see if they left the house, and all sorts of big data sources about restaurant visits, and it's seems pretty clear that we bottomed out somewhere around mid-April in terms of economic activity, and it's begun to slowly increase. But I think a sober assessment is obviously the right one. You'll remember back in the crisis, we gave up pretty quickly, thinking we were going to see V-shaped recoveries. And I think in terms of the level of economic activity, there's nothing we're seeing that is suggesting that that's in the works right now. Sort of all the second half forecasts by anyone who's in the business of doing forecasts, for what it's worth, looks for a reasonably strong second half, but that's reasonably strong off of an unprecedentedly low base. So getting back to normal feels like a multi-year project right now.
The ongoing debate over the shape of a recovery has bordered on being amusing, I would think, with V's and U's. And I saw one the other day, a tilde, I think it is, which kind of goes like that. And W's, if we have second rounds or second surges of the virus, or a Z. So I've seen about half the alphabet used to describe the recovery. At the moment, I get the sense that there are a couple things happening. One is, and I'm interested in your view, Dave, the damages or the implications of this economic suppression that we have been through are continuing to cascade. There are more and more announcements, or there are continuing announcements of job loss, of layoffs or furloughs and so forth. At the same time, with the opening up, there is some sign of life coming through. So there is a bit of a recovery. So to me, there's a little bit of a question of whether the continuing cascading is going to overpower the recovery, or if the recovery from reopening will actually become the dominant factor in how the economy evolves.
Yeah.
I continue to see an enormous amount of uncertainty, because fundamental to the uncertainty question is the uncertainty regarding the virus itself. That is the public health uncertainty from which the economic uncertainty really derives.
Yeah, so that's in part the big, the huge difficulty in trying to assess what things are going to look like 12 months from now, because the virus is in control. And policy really is not. Policy is all palliative at this point, and really can't do anything if the virus shuts us down. Assuming that we sort of work our way through better treatments and vaccines and all that sort of stuff, there's some good news. The good news is that if you look at both sort of the official Bureau of Labor Statistics household reports and our reports that we get from our surveys of businesses, it's still the case that about 3/4 of those kind of job losses are perceived to be temporary. That is, both businesses and households think that on the other side of this, and the other side of this being, as we begin to open up, those jobs are going to come back. So that's actually some very positive news. That said, there's going to be some real structural change to operate through. We've done a couple of surveys where we've looked at kind of the mix of how firms, which firms are going to experience growth going forward, and which firms don't expect, both across sectors and within sectors. And we're detecting in economist language, this is the reallocation of economic activity from one place to another. And we're seeing levels that are just, order of magnitude almost larger than what the pre-crisis signals were. And so you can think of things like online versus bricks and mortar, a trend that was already underway, which will be accelerated. We just published a macro blog today that involved asking the question of what fraction of work days will be at remote, at home. It was about 5% pre-crisis or pre-pandemic, and it's triple that now. So these are major kind of structural issues, and how those things don't often play out very quickly.
In the financial crisis of 2008 and the recession that followed it, many firms used that, if you will. They used it as a reason and to some extent air cover for restructuring their employee base. And so some jobs were lost permanently as firms tried to reduce their cost structure and basically let go what the people they considered to be the weaker performers. And I am picking up from articles that some of that same theme exists today, that firms are looking ahead. They're not sure how quickly the economy will come back. They're not sure if the economy will come back fully to what we had in, say, January of this year. So they're beginning to think about effectively restructuring their workforces, which means some long-term damage. Now, you're getting reasonably optimistic vibes in your conversations with businesses. It's still probably early in the game. Is the Fed concerned about long-term structural damage to the workforce and a long haul to get back to anything resembling full employment?
Well, so first of all, I don't speak for the Fed, so that's got to be be said. But I will speak for kind of how your former staff is thinking about it. I mean, to be honest, we're not picking up a whole lot in terms of the desire to restructure kind of the workforce in a fundamental way, or anything like sort of the employment dislocation that we did, in fact, experience really significantly during the Great Recession and the aftermath of that. Now it's early, so it's hard to tell. I think if you ask me where I would put my larger concerns, it would not be so much in terms of the return to employment, which I do expect will be somewhat slow. If you ask me to pencil in a projection of the unemployment rate, I don't know, 2 years out or something like that, I probably would not get much above 6%, or much below 6%. But the story of the last last expansion and the post-crisis period was the inability of capital expenditure and investment to really return to anything that could, be characterized as a true growth position. And you pointed out sort of the uncertainty and the potential impact of that, and we're kind of doubling down now on that uncertainty. And I don't know that that bodes well for the capital investment picture, which is important. I know one of the things you worried about for a long time was labor productivity and the growth implications of low investment levels, and that bounce back concerns me quite a bit.
Before we talk a little bit more about the outlook, and you've already touched on it a bit, but let's spend a couple minutes on the initial action of the Fed, which was to stabilize financial markets, to deal with market functioning, and again done in rapidly and with very strong measures, and the, let's call it, connected question of global systemic financial risk. Now, again, I'm an outsider now. I'm not following all the data on each financial instrument, each market, whether it be mortgage backs or corporate debt or municipals or treasuries or whatever. My sense is that those initial interventions have been pretty successful, all things considered, and those programs have worked well, and that now the Fed is basically calibrating their daily asset purchases to the relative health of the markets and the need for support. When asked about global systemic financial risk, my answer up until now has been it is a concern, but it's not front and center at the moment. The banking system, U.S. banking system particularly, seems to have weathered events so far rather well. The banking system was considered well capitalized and in pretty good shape going into this crisis. And we haven't seen yet a triggering event that starts the kind of thing that we experienced in 2008, which was quite literally global. I am concerned about emerging markets and you and I discussed this the other day, Dave, about the stress on emerging markets, on their currencies and on their debt positions, and the apparent need to either restructure or have some kind of a payment moratorium as perhaps one area of weakness in the global system that could trigger something that compounds what we're dealing with now, which is an economic downturn that is unrelated in many ways to the financial sector. So you're a little closer to the daily market activity, which of course takes place in New York. What's the situation in terms of those LSAP programs, large scale asset purchase programs?
So of course, the real action is sort of in the 13.3 and regulatory realm more than the QE sort of things per se. There was a very immediate, noticeable, and effective response in financial markets pretty much across the board that followed from the actions taken by the Federal Reserve. Markets appear to be working pretty well, and in particular for high quality debt, for example, quite well, and feels pretty normalized. Of course, there's still stress as you go down sort of the credit quality ladder across the board. Municipal debt financing is still under some amount of stress. We're starting to see credit markets tighten up, and emerging markets, of course, are always sort of the big shoe that might drop outside of the of many ways outside of the reach of the things that we can directly intervene in. So far, so good. So, I mean, I would, if you ask me, does it appear that there seems to be a big hammer that's ready to drop on top of our heads? The answer seems to be no. It's not at all that obvious that some of the, elevated amounts of stress in markets, and by stress I might mean, like high spreads to safer assets, low volumes, and those sorts of things. It's not all that obvious that that's not market pricing risk and taking a reasonable account of the truth of the situation. Whether we can count on those sorts of that sort of quiet to continue, and the sort of function that we have been able to maintain is, of course, anybody's guess. But right now, the economy, as we were talking about, seems to be on the trajectory that we had hoped it would be, which is some measured but positive recovery. And as long as that continues, I mean, I'm hopeful for sure that we will not see a flare up of kind of any acute stress in financial markets outside of maybe some pockets.
Let's go to the outlook, and I can say that you and you're privy to far more information than I am. You're a bit more upbeat than I have been recently. If someone poses the question, how do you see this evolving? My stock answer is, first you have to start with the uncertainty related to the virus, as I said earlier, and come up with a narrative for the evolution of the epidemic or the pandemic that revolves around really mitigation efforts while we're waiting for a vaccine, and to what extent those efforts require some amount of shutting down the economy or some amount of discouraging people from being out and about and consuming and so forth. And then the timeline to get to a cure of some kind, cure being really a code word for both vaccine and very effective therapies. From what I read and follow in the media, that could be soon. It could be as early as the end of the year. Anthony Fauci made those comments yesterday. He's probably the preeminent epidemiologist, at least in terms of press coverage. And others have said, well, there is no guarantee we'll find a vaccine at all. This could go on for years in one form or another, living with and managing some amount of epidemic could be a multi-year kind of thing. So I think you start there, and there's a great deal of uncertainty of how that's going to play out. And then from the point of view of the economic outcomes, again, Dave, I maintain that you can't have one forecast. You really need to consider a range of scenarios, from a relatively optimistic one, which you seem to some extent to be characterizing, to a grimmer one that involves waves of the need to constrain the economy, and conceivably, as illiquidity turns into insolvency, a major theme that I know has been on the mind of Jay Powell, that then begins to create long-term damage that gets to be structural and takes many years to get out of. So I think both ends of that spectrum are plausible at the moment. And maybe I should ask you a specific question, if you're willing to answer, and that is, will the FOMC actually issue forecasts at the June meeting?
Well, that is not something I can answer. it is obviously a scheduled meeting and for a forecast to be issued. Whether they decide to or not, I mean, it's beyond obvious that everything has to be taken with a great deal of caution and a recognition of the utter unprecedented, really unprecedented. I mean, you and I have been through some pretty uncertain and cloudy times, but I think that this one beats all of those episodes, largely for the reasons that you mentioned. So my sounding somewhat upbeat is completely conditional on something I know nothing about, which is sort of the medical kind of side of the events that will unfold. And really, all bets are off if there is a major unmanageable reemergence of the virus and its spread. So I'm really counting on that sort of not happening, recognizing that if it does, then a forecast is almost useless, because I mean, who would have thought we would have had sitting in January, even when we knew about the virus, that we would find ourselves in a situation where GDP in the United States is shrinking by 30 to 40%. Annualized in a quarter. So it is not a good time to be a forecaster. If there ever is a good time, this is not one of them.
Yeah, I actually thought it was admirable that rather than try, the Fed just said, this is not a forecastable situation. And in the March meeting, didn't come out with a forecast. And, for what it's worth, my guess is that would be a prudent thing to do again in June. Let's talk a little bit about this illiquidity to insolvency risk. The Main Street Lending Program, which is a 13.3 facility where the Fed is actually using the banking system with a Treasury backstop for loss to lend to basically mid-sized, mid-cap companies. It's taken a long time to get to a point of implementation. It still hasn't been implemented, but in Jay Powell's last press conference, he said end of this month. So that's basically tomorrow or early next week. Why has it taken so long?
Well, it's taken long because so it's novel. It's a new facility. It's not something we've done before. There are fine lines to be walked between providing kind of the support for viable ongoing enterprises and not putting the taxpayer too much at risk, versus being overly cautious and not as aggressive as the circumstances call for. I mean, we've now got 3 versions of the Main Street Lending Program that are consequences of learning about what is needed by virtue of trying to be very careful and connecting and making contact with the business community to figure out what will really work and what will be effective and what will position us well on the other side of all of this. So if you remember, setting up some of these facilities that we pulled the trigger on overnight in this crisis took quite a while during the financial crisis. And that sort of is the nature of the beast when you are doing something you really haven't done before.
Let's talk a second about ammunition, so to speak, what the Fed has in reserve that it can still do. And when presented with that question, my answer is, well, there's actually quite a lot in reserve still. Certainly, if you think of QE, quantitative easing, as in theory, at least, something that is infinite. You could continue to create bank reserves and fund either deficits or fund lending programs. So it could go on for quite some time, or it could expand a lot. There is some expectation in either this coming meeting or through the September meeting of forward guidance that begins to kind of explain what the Fed's intentions are for the foreseeable future in terms of a 0 to 25 basis point policy rate range, and also for the deployment of the large scale asset purchases. And then the other tool that has gotten a fair amount of discussion recently is basically yield curve management and caps at various points of maturity points, caps on the market interest rate, which of course would require intervention in order to control. What am I missing? Are those the major tools that remain available?
No, I think you have it right. The sense that I have, so I will speak for myself in this regard, is that the lessons of the post-crisis period, in particular, and by I mean on the post-financial crisis period, was that the balance sheet tools and forward guidance of various flavors. So there are several flavors of forward guidance that can all be deployed in different circumstances, whether they be conditioned on dates or states of the economy or simply open-ended. All in one form or another were effective and could be effective again. I think President Williams was speaking yesterday and noted that the committee continues to explore other tools, including yield curve control. I didn't read anything in that said that such a thing was imminent, and in a sense, this is still, again, we're a week and a half from a meeting, and the committee will make some decisions about the state of policy at that point. One of the decisions that kind of needs to be made is when will it be time to sort of pull traditional monetary policy levers and like forward guidance or like enhanced LSAPs and those sorts of things. I think to this point, those levers have been, what the committee has done is it's largely positioned itself for not having an appropriately accommodative stance when things begin to normalize. Then the decision is, when have they normalized enough so that those tools can be effective, and then which ones do you want to use? But I think that the ones that we now think of as traditional, we wouldn't have thought of traditional when you took the job, but we now think of as traditional, actually were effective and can be effective again.
Bill, I see you've come back onto my screen, so that means time for Q&A. The one subject that I wanted to have a conversation with Dave was some of the longer term implications of this. I suspect there will be a question about that. So let's just keep that in the parking lot, and let me turn to you for Q&A.
You're exactly right, Dennis, and thank you. And just let me remind our attendees, if you'd like to ask a question from the dashboard on the right-hand side, go to the questions tab. You can open that up, type in your question, and that will come into the queue. So Dennis, to the point about long-term implications, and this might be a question for both of you. There's a question from an attendee who would like to know, what's the assessment from perspective of R-star trend growth? And Dave, you talked a little bit about your outlook for unemployment kind of being in that, if I heard it correctly, high 5s, low 6% type range a couple of years out. But could you maybe talk about those three components of and the outlook for those three?
David, let me start by framing it this way. Prior to this crisis, say January or late last year, my longer term outlook was that we remained in what you and I used to call the 2% world, that getting an acceleration of growth into 3% or higher was going to be very challenging, and that for structural reasons related to demographics, productivity growth, and so forth, it looked like the best guess for the future was a 2% growth rate. I don't know that some of those factors have changed coming out of this, meaning that if we were in the medium term to get back to the status quo ante, something like what we were seeing in the fourth quarter of last year and in the early months of this year, January at least, I would, my best guess was we would resume that 2% kind of pace of growth. Now, there are going to be long-term implications, digitization, behavioral implications, investment implications in terms of what firms put their money into, that maybe will change the productivity equation or accelerate certain things. But I think it's very hard at this point to come up with a very firm view of what that future looks like.
Yeah, I don't disagree with that, but if you ask me to conjecture what I think the long-term growth rate, structural growth rate of the U.S. economy looks like, I would exactly put down the same numbers that you suggested. So I think a 2% world is sort of still where we're headed. I will say that if you project out over several years, I would anticipate, again, now this is all conditional on no reemergence of a severe dislocation from the virus, but we will likely and almost have to exceed that 2% growth for several years once we start cooking again. But that's simply because the level of economic activity will remain sort of below.
That's basically the arithmetic, right?
That's basically the arithmetic.
Yeah. Now, the question was about R star, which is the neutral rate of interest, and I gave a long preface to the point that the R star is likely to remain low. It had been downgraded in the time I was with the Fed from around more than 4% in the minds of many members of the FOMC to say 2.5%. And for the medium term future, I would think R star is even lower, that the neutral rate, in order to have a reasonable recovery, is going to, in all likelihood, be at 2 or below 2%. Do you agree with that?
Yeah, well, yeah, I had reconciled myself to a fairly low level of structure for the interest rates prior to the pandemic. This event is likely, I think, to keep us even lower than that for some period of time, and of course that has implications for policy rates. And in the end, this sort of gets back to whether or not this uncertainty and the retrenchment of spending by businesses and consumers remains as muted as I think most projections suggest. And when if that happens, then the pressure is downward and not upward. Now look, 10-year Treasury at 70 basis points or so, that's pretty low.
Yeah.
And so I would not be in the business of conjecturing something even lower than that. I expect something moving northward, but not quickly.
Bill, we haven't done full justice to the questioner's multifaceted question, but why don't we move on to another question?
Well, thank you, Dennis. This is along the same lines of a long-term implication around the inflation story. And there is a growing chorus in the market that expects disinflation and then inflation. But we've also seen an argument for a long-term disinflation view and a case for long-term inflationary view. So maybe we could talk about that as well in terms of the outlook for inflation on a 2 to 3 year horizon.
Well, let me just say a couple things, and I'll turn it to Dave. Dave has access to much more in-depth inquiries or studies on the dynamics of inflation. I am persuaded that inflation is something of a puzzle and has been for many years. The basic theory that everyone had, and when you took Econ 1 or Econ 101, was that the expansion of the monetary base, if not controlled, would ultimately lead to some form of hyperinflation or at least very aggressive inflation. Didn't play out the last time around. We expanded the monetary base, not so much the out there in the economy money supply, but the monetary base in the last financial crisis. And now we're doing that very aggressively again with the Fed's balance sheet growing conceivably to numbers that are like 8, 9, or 10 trillion dollars. At least some forecasts have used those numbers. Does that automatically mean that it's going to translate into undesirable inflation pressures? You know, I'm not willing to go there. The history of the last decade or more has been one of very muted inflation. And I would, if I had to make a binary bet, I would bet that, again, we're not going to see a terribly bad inflation outcome coming out of this this particular crisis. That it will, if anything, remain something of a struggle to see underlying inflation get to 2 or a little bit more than 2%. But again, the caveat, I think Dave has access to deeper thinking than I do. So Dave, what's your view?
Well, I never had access to deeper thinking than you, so I kind of fundamentally agree with you. The near term is pretty interesting because if you look at the recent reports, for example, the dispersion of price changes is very large. If you looked at food, it's just sort of very high, and if you looked at energy related stuff, of course, very, very low. And there is a bit of a race in the short term here between how fast capacity comes back online versus how fast demand comes back online. And that's sort of the great unknown about inflation dynamics. Now, that's all relatively short-term stuff, and will play out over a year or so. In terms of the longer term, I mean, we went again. I mean, it's useful to sort of go back to where we were in December or January and think about where we thought we were headed prior to all of this, and it was the view of those of us at the Atlanta Fed, articulated by Raphael in particular, that we were on track for the 2% objective, that if we look back over the trends and sort of tried to decompose what was suppressing the inflation rates, these weren't things that we were particularly worried about as symptomatic of an inability to kind of be pretty near that 2% target. So I guess I'm a little bit optimistic about the longer term, although in the short term, it could go lots of different ways, depending on again how the supply and demand stuff sort of shakes out in the dynamics of this recovery. I completely agree with Dennis that the balance sheet is not first and foremost among my concerns about kind of the inflation outlook going forward.
If I had to, Bill, if I had to again place a binary bet, deflation or inflation, I am more concerned about deflation. That is a worst case economic scenario could create that kind of a problem. And one of the conclusions I drew, and I was well taught by Dave and his colleagues when I was at the Atlanta Fed, is the central bankers pretty much know what to do about inflation. You know, for better or worse, you jack up interest rates and try to cool off the economy. Central bankers are not so well equipped to deal with deflation. And so I consider deflation to be the bigger concern, but also I wouldn't put it as a, you know, let's say a high probability at the moment.
So before we leave the inflation deflation debate, Dave, a question for you. The velocity of money as measured has been systemically low. What's causing that? Is there any catalyst to change low money velocity?
So the big surprise, I think, in the sort of normalization to me, the big surprise to me in the normalization of the balance sheet that had begun, you know, several years ago and was reversed, you know, basically beginning last September, was that the velocity, if you want to think about that, or the demand for kind of reserves in the banking system, was very much larger than what I had anticipated, and that became reflected in sort of the reversal of the rundown of the balance sheet prior to the pandemic. So I think, you know, we attribute that to several things: regulatory changes, for example. And a risk-off environment is one where the demand for kind of safe stuff is going to be high. That's as true in the banking system as it is kind of in the pockets of individuals and the balance sheets of businesses. Whether or not the kind of extreme levels that we ran to over the past couple months is a steady state. I mean, I would not conjecture that, but I think if anything we learned from sort of the past expansion was that there is the capacity to sort of feel your way through the kind of appropriate balance sheet adjustments. And the FOMC has proven itself to be pretty facile at making the adjustments in real time when they need to be made. So I don't know if 7 trillion is the right number for the balance sheet going forward, but I think whatever it is, we will manage our way to it.
So to that point, Dennis, you made a comment during our prep call. We were talking about what is the normal balance sheet? When will we, and when, see the balance sheet get back to a level where it was in 2019 or before? Can you just talk a little bit about how you would envision the Fed's balance sheet adjusting, both in terms of magnitude and duration?
Well, if it goes up, as it has been, and there's likely to be more expansion of the balance sheet, at some point there will be a decision to begin the process that has been euphemistically called normalization of the balance sheet. And as Dave just pointed out, that was a little bit of a hit and miss process, at least at the end, where the end game was to figure out what level of bank reserves are comfortable for the banking system and are necessary for desired levels of liquidity. And in fact, there was a little bit of overshooting that number as the balance sheet earlier was brought down to something. I think the total balance sheet was around 4 trillion, but the bank reserve number was about 2.5 trillion, something like that. And I would expect the same process to take place. And if I'm right that inflation is not likely to be an outgrowth of the scale of the balance sheet, then the Fed can do that very gradually. It can let runoff reduce the balance sheet. No need for particularly for asset sales to get down quicker. And my best guess is that that story, that narrative will play out again. It'll be a gradual process of shrinking and allowing runoff to bring the numbers down until a more, let's just say, a steady state number has been discovered through that process.
Okay, thank you. Dave, back over to you. One of our questions is why the Fed's purchase, they're suggesting it was 1.5 trillion over a 9-week period, purchases of US Treasury securities. Why was it so big? Why did it need to be of that size?
Yeah, I mean, so I'll characterize it this way, which I sort of alluded to earlier, which is I think the way that I think about the monetary policy response was threefold. One, of course, was first and foremost the liquidity facilities, which were the key policy move. And then there were the more traditional monetary policy levers, which included running the funds rate back down to zero and the LSAPs. It was not a time, if you ask me, to be inadvertently tight with monetary policy. It was a time to be relatively aggressive. So you don't want to, in real time, be constricting whatever demand could be retained in the circumstances. And then second, you want to position yourself to be in a stimulative stance when the time comes to roll out of this, and the timing of that is not very certain. So sort of being in advance of it makes a whole bunch of sense. And as we just talked about, is the size of the balance sheet something to be, overly concerned about in terms of what disruptions and problems it might cause? I think the answer is no. So the risks are clearly tilted in the direction of wanting to be more aggressive than less aggressive. I think that was the communication that came out of the Federal Reserve, and of course, I'm paid to be supportive of the Federal Reserve actions, but even if I wasn't, I would be.
Understood. Thank you for that. Dennis, you talked about the need to, in the last crisis, to stabilize financial markets and the financial system. As you look at where we are today, are there vulnerable points in the U.S. or global financial structure that concern you?
Well, one of the things that I learned, or at least I observed in the last round in 2008, is that a relatively obscure triggering event can then create some kind of a crisis of trust within the financial system, and can produce contagion that moves rapidly, is hard to contain. I don't believe that at least the banking system today is even close to being in that kind of a fragile state. But here in the United States, especially, we have this enormous non-bank shadow banking system that operates in debt markets as lenders, for example. And, there certainly could be disruptions coming out of the less regulated and therefore less observed parts of our financial system. The other concern I've already mentioned, and that is that the global South, the developing markets, are in a tough situation. If this goes on for a long period of time, some of them are going to be in extremely dire straits with the need to restructure their debt, which means that there will be financial exposure among the large banks and large financial institutions around the world. And I guess if I were to summarize my worrywart kind of concerns, is that you have a two-dimensional problem here. You have the underlying virus that is causing economic problems, and if that doesn't improve and in fact cascades or gets worse, then you could have a late developing financial crisis of some kind. And so I think we have to watch for signs of fragility and then signs of incipient stress, and then the authorities are going to have to figure out how to address that. Now, kudos to the Fed. There was at the very early part of this, their response, a renewal of swap lines with the big five central banks, then an expansion of swap lines to another, I think the total number is 13 or 14, and then the introduction of a repurchase agreement facility for banks that had typically not been part of the swap structure in the past that are now, so that if they just wanted overnight liquidity or whatever, they could get it through a repo facility with the Fed. I think those are very innovative and the right thing to do to address the global systemic risk picture.
Great, thank you. We've got time for two more questions. Dave, this one to you. Based on the work that you and your team have done, do negative interest rates actually work? And this is more from a theoretical standpoint and modeling it out. Is there room for that in the policy toolkit?
Yeah, I mean, so the wishy-washy answer I'll give you is I think it's an open question. I will tell you my staff is of mixed minds. I would say probably on balance they are of the view that if they in fact worked elsewhere, and that's a matter of some debate, it is unclear that they would work so well in the United States. It's sort of a different financial market structure. If you listen to the committee members, they, no one's been overly enthusiastic, I think, about invoking negative interest rates.
Yeah, I'll step in. I think we've lost Dave here for a second, but I take what they say at face value, that it's a non-starter for Fed policy, maybe with the slight caveat that negative interest rates would be a last resort, and in the most dire picture of the world, state of the world, you never say never to something that has been used in other places and is theoretically possible. But I think given the current, let's say, plausible range of outcomes, we are not going to get to negative interest rates. Have we got Dave back? I don't know. I guess not.
Yeah, I think the question scared him, so it froze him in his tracks. So
yeah.
So let's Dennis, let's wrap up with this last question regarding the Main Street lending program. And there's a two-part question. One, is it too late? It's coming at a time when we are starting to see some green shoots, I think. And secondly, does the Fed risk moving into the commercial banking space through this particular program? Do you have a view on that?
Let me take the too late question. There are two ways, I think, to think about whether this program is going to be too late. One way is that the situation has worsened enough. It has gotten into an insolvency crisis to the extent that the mid-sized firms that are targeted for that program are going to think twice about adding debt because they may have come into the crisis fairly indebted, and then as things have unfolded, have found themselves very reluctant to take on more debt. That is one way of thinking about it, being too late. The second possibility is, as you point out, Bill, the green shoots means there's hope for sort of surviving this or for working through it, and therefore a desire not necessarily to add debt, because it's not, some firms are going to say, we think we can get through with our current capital structure, and we think we can get through this to a better day without compounding our indebtedness. So which of those could produce a too late? I continue with what I learned in the Fed, and as I worry about the future, I worry about the insolvency potential rising enough that firms are just saying, and this money arrived too late to bridge us to a better situation or to the disappearance of the problem, and we're just going to have to deal with our situation as it is. If it's implemented this coming next few days, I think the answer is it's probably not too late, but it's risking being sort of late, and therefore it's not as effective as it could have been earlier. I understand the technical questions. The Fed is not in the position of losing money. It's a lender of last resort. It does that against solid collateral. It's not supposed to lose money for the taxpayer. And the Treasury has allocated a certain amount of congressionally passed allocated money as a backstop, if you will call it risk equity in the lending programs. So the Fed has to design this so the great lion's share of loans turn out to be repaid as expected, and the losses are manageable, and on net, probably the program is profitable for the U.S. taxpayer. That's the way it has to be designed. They have to do that through the banking system that apparently is going to retain 5% risk. And so I suspect it's a very complex question. And what we learned from the PPP program is when it came out very, very fast, there were a lot of unanswered questions, and therefore a lot of disruption in the first several weeks because the designers hadn't thought through every wrinkle. And this one is more thinking through every wrinkle and getting it right the first time, with some risk that it comes in too late. So that's the way I feel about the Main Street program. I hope it's not too late.
Great, thank you for that. So unfortunately, we're going to have to leave it there. I want to thank Dennis and Dave for fascinating discussion and conversation. A lot of insights there, and we really appreciate your spending time with our GIC community. Before we close, just a couple of programming updates. So next week on June 4th, we're going to have a program that's titled The Cure and the Disease. And this will be with Dr. Jeffrey Gold, MD, who is the head of the University of Nebraska Medical Center. And then that'll be followed on June the 11th with a program titled Challenges in Economic Forecasting, very much to what Dave was talking about. And the challenge, we'll have some leading economists talking about some of the challenges of forecasting in a post-lockdown economy. So we hope everyone can join us for those two events. Second, the GIC staff has asked me to remind everyone that we are offering a 10% discount for all new members, and this offer is good through Friday, so it's a limited time only, so hurry and take advantage of the savings. But we also wanted to make everyone aware that one of our GIC members has established a very generous matching donation challenge. So through the month of July, any donation that you make, whether it's $25 or $250 or $2,500, any amount, it will double in value and impact through this dollar for dollar match. Your donation and the match will go directly towards bringing high quality content through the executive briefing through the remainder of the year. If you'd like to learn more about membership or learn more about the matching program, you can do so by going to the GIC's website, and that's at www.interdependence.org. So as we conclude, I encourage you to take just a minute to respond to the audience survey at the end. It lets us know how we can improve the program. Your feedback's very important to us. I want to thank you for your attention and good afternoon.
Thank you.